Rajiv Batra joining in, Head of Asia and Co-Head of Global Emerging Markets Equity Strategy at JP Morgan. Rajiv, great to speak with you on the show as always, and thank you so much for your time to us. I want to talk a bit about the extent of optimism on Indian corporate performance this quarter, and do you see this as a shifting trend as far as the last 5-6 quarters are concerned?
Thanks, Amanda, for having me back again, and good morning to you and your viewers. Definitely, it's a shift in trend happened 1 quarter earlier compared to what consensus was expecting, and maybe in line with what we were highlighting to people that first quarter of this fiscal year, the turning point will start happening, that you absolute form a bottom, and from second quarter you will start seeing the green shoots. Our green shoot thesis was more premised on the policy tailwind, which started way back from December last year, where you saw the slew of CRR cut and liquidity injections by RBI, and then followed by tax cuts in budget, and then 100 basis point cut both on CRR and repo this year itself, and then followed up by GST. Mind it, in this quarter, we have not seen the full effect of GST cut yet, because that only was visible only last 8 days of third quarter of this calendar year. But this ongoing quarter will also give you good amount of a tailwind even from the GST rate cut. So taking that factors into account, we are very confident of seeing double-digit earning growth in second half of this FY26, and potentially you can say a low double-digit growth number even in FY27.
Okay, so if I look at what you thought has done, relatively better, materials, financials, consumer, hospitals, but I want to talk about IT with you today. Maybe not so much in terms of the corporate earnings, but a shift in mood and an understanding of what AI is going to mean for some of those Indian IT companies. Are you seeing that trend as well, Rajiv? Are you buying into that optimism that AI now goes from a headwind to a tailwind for Indian IT?
No, at one point of time, it will have to go into a tailwind also rather than being headwind. But that question will come when we move from an AI build-out phase towards more an AI adoption phase. Too early to say AI adoption phase is on. I'll just jog your memory back to the last year. If you remember, we were in December and January, like December last year and early January this year, a same narrative was being played out that we need monetization, we need cash flows and earnings, and Capex and the build-outs are peaking over there. So adoption becomes a key. And hence, this is the reason why December last year and early January, software services started outperforming tech hardware, not just in the US, but globally overall. A same kind of a view and approach is happening back again over there. To be very frank, everyone has not found their modes yet in terms of monetization fully. It will take certain amount of a time. In between, it will keep on coming, but I'll say too early to say that we are going into the adoption phase. It could be a story 12-month, 18-month down the line, but right now it's too early to get hopeful on.
Rajiv, that's interesting. Hiral, on this side, you're saying it's too early to get on to the AI play when it comes to Indian IT. But if you have to look at a long-term play, if you have to tie that up to valuations and what IT as a sector has done so far, would you say this would be the right time to start nibbling in? And if so, over the next, say, 6 to 12 months to actually understand whether it's going in the right direction or not, what would be the chronology in terms of mid-cap versus large cap?
Definitely, it will vary on stock-by-stock basis. Like some of the players will be ahead of the curve, and they will start getting the benefit of adoption. And so far, some of the mid-cap names have shown that tendency on an adoption side. So they are benefiting at this juncture compared to their large-cap counterparts overall. But you just touch upon a very important point on the valuations and the earning growth fund. The sad part of our investment or the global investment thesis is everyone has a rear view mirror. On a rear view mirror term, if you look at the valuation of MSCI India IT, it is trading close to 19 to 20 forward P basis. But when you look at a trailing earning growth, it is flat, that is 0% to around plus 2%. So when you look at a PEG ratio, your PEG ratios are coming more than 5x or close to around 8 and 9x for the entire sector space. Now, this is the same curse which FMCG sector has gone for the 10 years. This is the same curse India has gone through for the last 18 months when the PEG ratios became uninvestable. But right now, that same problem IT sector is seeing, where your earning growth is missing compared towards other sectors like India overall or like discretionary and financials, and valuations are not that cheap enough. How lower valuations could go to make the future story hopeful? We believe it can come to the terrain of around 15p or a 16p for a sector to start becoming lucrative, where foreign investors and other investors can start revisiting. We are in kind of a mid-cycle kind of a phase where we have started seeing correction because of this AI story came into picture. Usually it is in the late cycle when the whole negativities play out, you may start revisiting it. So we think that could be the story by end of this year or early 2027, where adoption start becoming reality and software services and all come into picture. Till then, market will just play to the tune on what is my valuation and what is my growth delivery.
So that's with IT, Rajiv. You know, the other important aspect when you're saying is, one, you're seeing a structural shift when it comes to earnings or valuations with India's story. Number two, you've given out a couple of factors which will get FIs back to India. Now, to add to this, if you have to look at emerging markets as a basket, India versus China. In fact, earlier during the day as well, we just spoke to one of the analysts who was of the opinion that probably you have to look at India separately and not compare it to a China as well. How quickly do you think India is going to be able to surpass China's weightage when it talks about MSCI indices? And what is that psychological impact it could have in terms of fund flows?
So too early to say that to surpass the China kind of a weightages. We need much more, you can say, liquid in-depth market where people can invest, not just by foreign investors, but even locals all jumping and deploying money. And definitely a lot of the sectors which are in unlisted spaces should start coming back into the market, be it on the space exploration side, in the robotic side, that comes in line with what my global sectors or the capital market look like at this juncture. But till then, I'll say it is not an apple-to-apple comparison to be made between India and China over here, because the starting points for both the markets were different. In case of a China, valuation was cheaper, but growth was missing. In case of India, valuation were expensive, but that expensive valuations were getting justified by growth. That start got it missing from last 12 to 18 month period. So in case if India can bring growth back on table, low double digit kind of a number, and that keeps the PEG ratio of India around 2 or lower than that, India still looks like an interesting story compared to China overall. But as we are moving ahead, and you can see the way global ecosystem is evolving, where more focuses and attentions are being played towards semicon, robotics, biotech, space exploration. If our capital markets, or you can say listed company space, start also moving towards that direction and skew of weightages move towards that, yes, definitely India can compete with China, India can compete with other developed markets also.
Rajiv, in terms of sectors, financials has been on everyone's top favorite, and you talked about the valuation growth matrix. How do you think financials are faring on both those parameters right now? And within that larger bucket of financials, what are you seeing in a more positive light?
No, so definitely number one sector which is on our valuation list looks cheaper is financial overall. When we look at on the PE matrices, or when we look at the price to books metrics also. Growth, yes, it is a bit multi-speed within the financial spaces overall, where you are started getting supportive growth from NBFC spaces from PSU bank. That's where it is lagging a bit because of a NIM contraction in a private bank space. Capital marketplace are the structural growth plays where people are willing to pay higher and higher premium, which we are seeing in primary markets also. So taking that factors into account, once we are done with the RBI rate cutting cycle, that gives some headroom to my private banks to start worrying, to stop worrying about NIM's contractions overall. So that will be one positive. But beyond that, the key thing to watch is the deregulation which is happening, the opening of M&A financing space. M&A financing has been the big part of India, like close to $60 billion industry last year. This year, close to around $38-40 billion. If M&A financing becomes viable because of deregulation towards the banking space, it can further inch up the loan growth for entire the banking system beyond your consumption-based loan growth or MSME or NBFC-led loan growth. So we remain very positive on the ROI expansion side, on even on the loan growth side, where banking sector should keep on benefiting. And like in the coming year or two, I'll not be surprised if it trades at a premium valuations compared to its own history, or trades on par valuations with other sector.
Okay, so no, that's very clear as the financials are concerned. But for capital markets specifically, Rajiv, because you've had so much focus on capital markets, not a very large bucket of stocks, but then there's a recent listing which has done exceedingly well and unlocked sort of that potential. Is this a space that you're bullish on?
Yes, we are very bullish. It's one of the structural theme, not just within the India, but across Asia and emerging market. Localization of equity market, it's a key play where like only in Taiwan and Korea, where we see 24% of the households are owning equity market. If we go outside of Korea and Taiwan, be it China, be it India, household ownership is a mid to low single digit kind of a number out of their total asset allocation. And with the way which the return on the fixed income side is becoming anemic, and inflexibility which is there is in real estate as an asset class, that makes equity as a very attractive proposition for my households within India, within the emerging market space. So we do believe like capital market as a theme will remain vibrant for the coming decade, entire decade in India. And also as the wealth shift also keeps on happening from baby boomers to millennials to Gen Z, the culture of financializations of assets and equity market doing well will be the game in town.
You're talking about capital markets, Rajiv. Apart from this, if you have to look at the overall play when it comes to the Capex cycle, I think in our earlier conversations as well, you have indicated that by 2027 is when you're seeing that entire Capex growth cycle to come in as well. Would you say this would be a right time to start nibbling at the Capex play? And if so, which are the sectors and stocks that you would advise investors to look at?
So one, we need to recognize that the Capex cycle is also transitioning. If it's transitioning from traditional sector to the new age sector, it will be unfair to say that only government Capex is happening, which this year we have budgeted around 14% growth. We are also seeing happening Capex happening on the private side also, be it in the space of defense, be it in the space of data center, or even now EMS industry side, even in terms of renewables and EV. In traditional industry, it is still in the same cement, energy, and metal and mining sector, but in the new age industry also it is coming up. The broad thesis over here is that if my domestic demand is making a comeback, it clearly means my utilization levels will start moving higher. Domestic demand was not in favor for almost 3 to 4 years post-COVID overall. The country was growing largely through external demand per se. And this is the reason why, with anemic domestic demand and top of it, you can say competition from China, and plus you can say efficiency coming into system, because of which you don't need to expand your capacity, your utilization level didn't pick up. But all the policy efforts now, including the GST front, we expect utilization levels to increase, and that brings my private Capex in. But till then, it will be a selective play. As I've said, from FY27 it will start. So we will need to look into spaces where it is happening. So as I've highlighted, the new age industries like defense, renewables, EV, data center, EMSs, these are the spaces where Capex is happening, and one needs to be very positive on such spaces.
Rajiv, I just want to get your take on some of the platform plays. Now, these labor codes have gotten notified over the weekend and they're going to have significant impact, which we will have to wait and see. How are you seeing the gamut of impact that we can see? Definitely positive for corporates overall. Positive for employee rights as well as for corporates, some of those very old rules getting knocked off. But for platform companies, the quick take as far as the markets are concerned seems to be that it's a negative because they will have to have a fixed amount spent on gig worker healthcare and welfare, etc. Do you see the impact of labor codes as a mixed bag for corporates?
Look, when any new law or any regulation comes, it's being always perceived that, okay, I'm not having any arbitrage anymore over there as such. But the most important part is we have seen historically whenever there's a formalization in a particular industry or a particular sector per se, which here in this case we are seeing in the labor factor over there, it is not just beneficial from that factor perspective, it is beneficial for the entire industries. So this is the same thing can happen with the platform also. Currently it is being pursued as a negative, but let the dust settle, give it few more days and let people come out with their analysis on this one, and I think it will not be appearing as negative as what market is pricing is at this current juncture over there. As I've said in the past, deregulation is going to be the crux and very important for India, and we should all appreciate that beside what RBI, SEBI was doing, now the deregulation is broadening out in terms of even the labor market and other factors also. So if this factor reforms keep on continuing, it will unlock further growth for India in form of productivity. So this is what is keeping me interested right now on the labor reform term, but we can definitely come back to you with more once we are done with our analysis.
In terms of specifics, Rajiv, there are some EPS revisions that, you have talked about, or the reports have actually talked about, more specifically BPCL, Suzlon, HPCL, among them so is Canara Bank. Are you bullish overall on the PSU pack in terms of banks?
So in terms of financials, yeah, the number one pick from a strategy perspective is PSU banks, followed by NBFCs, then followed by capital marketplace, and then lastly private banks. No, we are overweight on all four spaces, but the pecking order top priority is PSUs because we think they will be the initial beneficiary of the loan growth pickup, and they are not hit as significantly by the rate cuts or the NIM contraction story what my private banks face through. So taking that into account, yes, PSUs. We are quite positive.
Okay. Very quickly, Rajiv, apart from the sectors that we've spoken about, now IT as a sector, we started discussing that, but the moment FI start coming back, the usual play is IT and banks. If you have to peg between these two segments, because IT has underplayed right now, would you be a buyer of IT versus banks, or would your allocation be equal in both these segments?
So we are overweight financials and we are underweight banks, and I think we are close to underweights, or you can say cautious on, sorry, we are underweight financials and we are underweight IT. We are underweight on IT for close to almost a year right now. As I've said, our length, we have a clear framework between valuation and growth, and then the policy, which is the third part of it. So taking these factors into account, it is playing well where will all the three boxes are getting clicked in the financial side rather than on IT side. Coming back to the foreign investors also, yes, in past, whenever foreign investor came to India, the three sectors which were always on the radar used to be financial, IT, and consumer. But if you go a bit deeper into this one, their clear focus is on growth. If growth is there, and especially premium growth compared to what they are getting in their respective country or source countries over there, then they will invest in particular sector. Right now, that growth availability or a hope is either there in financials or you can say in consumer, particularly in the discretionary space. So hence, this is the reason why when we look at the YTD flows also from foreign investor net flows, there is a skew of lot of negative flows in IT space, but you can say a flattish or marginal positive in the financial space.
Okay, thank you so much, Rajiv, for speaking with us. Pleasure as always. That was Rajiv Batra, Head of Asia and Co-Head of Global Emerging Markets Equity Strategy at JP Morgan.